TheoTrade. This is Don Kaufman. It's September 10th, 2018. You are watching the Theo Night video. Well, markets are a lot more docile than they were just about 10 years ago. Of course, I don't know if this is celebratory, but we are celebrating here the 10th anniversary of the Lehman collapse. At the time, I was actually working heavily in the brokerage industry, specifically at thinkorswim, and it was a precarious time. Could probably tell stories for days on watching, for example, the net liquidity of the entire firm kind of dissipate as we went off into the abyss during that financial crisis. Nevertheless, in today's video, I want to take a couple of minutes and I want to look at a few individual issues, a lot of emails that have come in about these particular underlyings. With that, let's get right to it. Let's start with the EEM. This is the emerging markets. I kind of feel that the EEM has really fallen off radar screens in a lot of the recent trade. Now, the reason I bring up the emerging markets is this has been just relentless sell-side activity, and any bounce has been met with effectively more sell-side activity. All right, this is a year-to-date chart, and you're looking at it down right now about 14%, again, on a year-to-date basis. But allow me for a moment to just back out the time and recognize kind of year over year, it's down just about 10%. So why am I bringing up the emerging markets? Are there opportunities? Yes. However, it's not necessarily what you may think. What I'm going to do on the emerging markets is I'm going to come up here to style. I'm going to cruise down to load style, and I've got a prefabricated IV rank and implied volatility. This is just a setup. Nothing too spectacular. And what I'm looking at here down below happens to be effectively the implied volatility. And this is what we call a 30-day or a VIX style implied volatility. And the implied volatility, the point that I'm getting to is if you look back, and again, this is pretty much over the last year, but if you look back over the last year, we're what? Picking up to just over like 21% IV, and yet we're right now at lows for the year. So this is a little bit of a cautious tale inside of the emerging markets, hence why I wanted to bring it up, because again, I've had a lot of conversations back and forth on emails specifically about the EEM. Earlier this year, I talked about it just ad nauseum so extensively because the IV had picked up so much. It was opportunistic even for selling premium. At this point in time, I would be incredibly cautious around the emerging markets. And moreover, I'm looking at the emerging markets, and you get a little baffled by this and wonder like, hey, what gives? Not what gives in terms of why it's selling, but why hasn't this spilled over back into US markets? And my belief, and strictly my opinion here, is that this has everything to do with the Fed, diminishing the balance sheet, along, of course, with the strength in the dollar. However, those two are kind of joined at the hip. So the dollar gets stronger, the emerging markets not looking so good. But the backdrop of that is the rise of interest rates, which is not going to be helpful to the emerging markets. At this point in time, based on those factors, and based, in the short duration, based on implied volatility, I believe that the emerging markets are going to continue to fall. However, within these falls, there are often bounces back to the upside. And I'm going to look for the opportunity, to short into the next bounce. At this, again, right at this point in time, and I'll zoom in for a second, this is not something you want to short into. That's what we would term shorting into the hole. And it's just, that's not going to be beneficial to you. Shorting when we get a pop to the upside, if we get to like 42.5, maybe 43, you're not going to be able to time the next, leg to the downside. An effort to just point out, like if we bounce, you can use an in-out spread, or you could use some type of duration trade where you're buying a deep in the money put. But that's one of the first underlyings that I wanted to bring up. Again, I'll reiterate my stance that the emerging markets does appear, that they're going to be poised to fall possibly further and much harder. Okay, in the near term, though, we are looking for a bounce back up into which we could short into. And again, this is one that's got me baffled for why it has not proliferated out. And that's something that we might be talking about here in the very near future because, again, any more sell-side activity in the emerging markets, and it will see a degree of proliferation. All right, kind of next on our list is some of the usual suspects. JP Morgan. So I have been incredibly critical of the banks lately. And I'll come back to JP Morgan in here, but I'll use the XLF, okay, which are the financials, as kind of the mainstay of this example. Why have I been so critical of the financials? Well, they get everything from deregulation to higher interest rates thrown their way. And again, higher rates. I mean, people, come on. Rates, the TNX absolutely took off last Friday. This is just last Friday. Obviously, today is a big nothing burger, but the rates took off. And what has been the impact to the financials? And the answer is absolutely nothing. I mean, they're slipping a little bit to the downside. Now, the most appropriate place that I deem there to be some edge isn't necessarily in the XLF. Although, if you like the safety and kind of the ETF products, the safety of the ETF product being that it's not going to have an earnings announcement, there's no CEO or CFO going to take it away in handcuffs, but it's up about 1%. So when I'm evaluating a particular sector, I don't just take I really want to trade JP Morgan. Like, I mean, come on, who doesn't want to trade Jamie Dimon? But I looked at Morgan Stanley. And people, I was short Morgan Stanley and short for a while, but it's down 8%. Even if I believe that the marketplace is going to fall in the financials, it's already down, the 8%. I got to find a financial that has been bid up. So I look around, right? I looked around at Morgan Stanley. I looked around at Citi. I looked around at Wells Fargo. I'm not even going to bring up Wells Fargo because don't even get me started there. I looked around at like Bank of America. And this is what I do. And in the evaluation mode of this, come on, I realize all the fundamental factors, behind, for instance, JP Morgan doing a little bit better than some of the other financials. Nevertheless, it's up 5%. And if the financials themselves are poised to fall, I would expect that JP Morgan would play catch up to the downside. Now, how do I position myself in there? Is I'm using deep in the money puts. And we're just on the cusp. And the reason I'm bringing this trade up, we're on the cusp right now of our first roll. We've got a position on. I've purchased the 140 puts. And yeah, we purchased them for over $20. Now they're trading almost $27. And I'm going to look to roll those out to the November timeframe. And I'm eyeballing, what am I going to roll to? I'm eyeballing right here, these 125 puts, but I want them to get up to an 85 delta before I initiate that first roll. And that first roll is going to be stellar. I'm going to take a $27 option and roll it to a what? Like a $12 option, That, people, is a roll because all of that risk that I have, that initial, $20 odd in the trade, I'm going to offload $15+ of that risk in the first roll. And that, that's what that's about. I mean, this is what trading's about. So again, we brought up the emerging markets for possible opportunity in the near future. We're bringing up JP Morgan because, well, it is in the midst of an opportunity, and JP Morgan really looks right now, it's on the edge of that move to the downside. Now, I'm not much of a technical trader. I'm not taking a technical test. I'm looking at it in comparison to what the interest rates are currently and effectively doing. Last but not least, got to bring up Tesla. Now, Tesla has turned into a soap opera of marketplaces. It just, every single day. And by the way, you think you would get kind of like nauseous looking at this. I really don't. I'm kind of intrigued by the entire thing because I've seen some crazy things before, but Elon Musk, it's just right up there. It's literally right up there. What I wanted to show you, and I don't think a lot of people are necessarily looking at, is implied volatility is flying again inside of Tesla. Now, implied volatility is right around, the 80% mark. Now, for those of you, if you don't speak implied volatility, well, this is probably not going to make a whole heck of a lot of sense to you. But implied volatility is back up to about 80%. Now, what does that mean? Well, it means that over the last, again, year in time, this has been and could be one of the best opportunities to be able to sell options premium that we've seen. However, the options premium that you would be selling, you would really want to consider selling the options premium a little bit further out in time. Now, I cannot stress this enough. You're like, well, why do you want to sell options premium a little further out in time? Because in the short duration, and let me show you, this is, again, an area that not too many people have tendency to look at. In the short duration, if we pull up what's called historical volatility. Historical volatility is the annualized standard deviation of past stock price movement. Historical volatility, okay, over the last, average over the last 20 days is 56%. So, and again, that's in the past, and that's important that you guys know that that's in the past. But the last 20 days have seen right around 56 vol. But right now, the IV is all the way up to about 80%. So if you're selling premium, 30, maybe 40, even maybe 50 days out, you're probably all right. Okay. But in the short duration, you better be really, really careful. So what I'm getting to with this is I want you to take the historical volatility, edit it down to just the last 5 days. Because what you're going to see, and I'm just going to knock it down to 5 days, what you're going to see is quite astounding. Okay. In this circumstance, I'm overshooting over there. There's the closing bell. Hit apply, hit OK. What I wanted you to see is that in the short duration, the actual price movement, again, this is historical volatility. This is actual price movement is 90%, which is well exceeding implied volatility. In fact, if you look at the implied volatility, and I'll scroll up here on Tesla, you look at the implied volatility over the next 4 days, it's only 66%. What is kind of crazy is it says, okay, over the duration, 40, 30, maybe 50 days out, selling premium probably will work. In the short duration, you actually want to be a buyer of premium. So this happens to be, I want to buy gamma in the short duration. I want to be selling gamma, okay, and selling some premium further out in time. It's a lot to think about on this evening's video. I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.